All right, welcome in everybody. Thank you for joining us on our what is this? The last AI Circle of September, the last AI Circle for the third quarter. I was just looking. It looks like the market's up 4% since we last spoke a couple weeks ago. So I'm sure there's a lot Kelly's got to go over on his market update. And let's just get him in here while we can. Kelly, how are you?
I'm doing okay.
Doing all right?
Doing okay today, folks.
Awesome. Well, you guys may remember a couple weeks back, I kind of teased you. I said we were going to have a guest on our show at the end of September. I bet a lot of you have never met him before. This is Rob Simone. Rob is our chief growth officer here at iFlip. He does a lot of things, but basically he's in charge of leading both customer and product growth. As one example, he and Kelly kind of put together that BitFlip portfolio we released a long time ago. So he'll give a little bit of input from his perspective on a few things. I guess either of you guys have anything you want to start out with besides just saying hi?
Strange times in the market and interesting things happening that I wouldn't say we've never seen before, but Kelly might say that. It's very, very interesting market update today for sure.
I think I can ditto that. It's I have to admit I never saw an interest rate cut when the markets were at all-time highs. So that is kind of an unusual thing, and we'll go over that in a few seconds.
Perfect. I only see a few people in here so far, so might be a little quicker one than normal, but that's okay. As you guys know, if you happen to watch this once the live stream is over, it is posted as a recording, so you'll still get all the great content. You'll just miss out on being able to ask questions in the Q&A section. So if you join us later, feel free to leave a comment on this video with any questions you might have, and we will gladly cover them next time. So before we say anything about the markets or anything like that, we do have to go through our disclosures just first because it is slightly different today with Rob here. He's obviously our guest. Here's the agenda. Market update as always. I don't believe there's been many trades. The market's just kind of plugging along and we're kind of going with it. As always, we'll do the Q&A at the end, and that is your gateway towards potentially being our Amazon gift card giveaway winner tonight. So with all that being said, here's our disclosure. So iFlip Investor Inc. and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk, and you should speak with your CPA or financial representative to ensure the iFlip smartfolios you select are suitable for your investment profile before trading in a live brokerage account. With all that out of the way, let's get Kelly back here. Kelly, you want to jump right into your screen share and get into the market update?
Sure, everyone.
Cool.
Well,
I will get that going. Give it one extra second. I got to get Rob and I out of here so that everyone can see your charts.
All right.
Sorry, I muted myself. So go ahead. Sorry, Kelly.
No worries. No worries. Well, look, hello, everyone. And this is what, September 25th, Wednesday, last AI Circle for September. 2 weeks ago, we were sitting in the market, and the market was kind of starting to turn lower. However, the market again resumed its move higher and has posted some new highs in the Dow Jones Industrial Average, as shown here. Sold off a tiny little bit today, just 300 points almost. And the S&P 500 also made a tiny little bit of a new high and just came down not even 20 basis points for the day. The only thing that has not made a new high yet is the NASDAQ. And the NASDAQ is still sitting off its high by approximately about 3.5%. So what's going on since the last AI Circle? Well, obviously a 50 basis points rate cut by the Feds. Marginal surprise. Most people were thinking 25 basis points, but we got the full 50. And of course, we have all kinds of expectations for further 25 basis point cuts going forward all the way into 2026, at least according to the Fed minutes after the announcement. So what is really kind of going on here? We have to focus on interest rates here. Fed funds was at 5.15. Now today, Fed funds sits at 4.67. That's actually the yield you can get out of your cash that sits in a market. But here is the example of the 10-year note. The other thing we have to note is when the announcement came out just last week, the market's actually sold off a bit since then. Not much, but it is coming back in. And if further rate cuts are to be expected, we can probably see a resumption of this 10-year note rally towards lower interest rates. Remember, the bond market is inversely related to yield. Just remember that price is inversely related to yield. Higher prices in the bond market mean lower interest rates. So we've seen that the most indices have made a new high except the NASDAQ. Mag 7, pretty much the same story. Apple close to its highs, Google way off its highs, Meta right on its highs, Amazon close to its highs, Microsoft just off of its highs, Netflix brand new highs, Nvidia trying to fight back for new highs. We'll see. Oil markets, we'll go through this kind of quickly. Oil markets have come down below $70 a barrel. It's nice to note that we're seeing cheaper prices at the pump. Obviously, the best bet against inflation or keeping prices down is lower oil prices. However, that is not going to necessarily translate into lower bread prices or milk prices or meat prices in the near future. So it's going to take a huge relationship like this to continue in order to see a huge resumption of further price decreases in the energy complex in order to see lower prices in result at the grocery store and in other places. If we just kind of go down the base here, the banking stocks remain kind of strong. JP Morgan, of course, leads the way. Bank of America kind of doing okay, not too far off its highs. Goldman, kind of the same thing, right on its highs. Charles Schwab, I always keep an eye on it. It always seems to be struggling. We'll take a look at some other issues that I really did like, and we have them in a couple of our portfolios. The telecoms, here's AT&T, nice boring stock, pays about 6% dividend, and we've had a nice healthy rally from about earlier in the year, which was we were priced around $16 a share area. Now we're at $21.50. So that's a nice healthy jump of about 40%. Verizon, not quite as well, but it is still making some new highs in here. And as a result, also paying the 6% dividend. So these are kind of companies that are looking good. I like them, and they're doing well in most of our portfolios. Obviously, we should jump over to Bitcoin. I'll go directly to the IBIT product, which we tend to own. We had a jump up in IBIT, not much of one, and we are holding steady here at about $36 a share, and that translates into a Bitcoin price of, if I just go the list, we'll go to crypto. I don't want the Dow. Sorry, folks. Give me a second as I mess everything up. Crypto. Let's look at the Bitcoin. 63,500 a coin. As you can see, it's just in a long pennant formation, sitting at a 200-day moving average. There is no indication higher or lower. My conviction, of course, is to be long this market. Over time, I think it will do well, but we must recognize that there's a risk to this market. That's why we have the BitFlip portfolio to help manage that risk the best we can, given the huge volatility of this market. Going back to some of the other things that are going on, we should take a look at the dollar. So we'll go back to that. I like to look at the dollar in terms of the dollar index. One of the things we have to expect is if interest rates go down in America, the dollar will go down. There is something called interest rate parity. And I think we might have heard this term before, but it basically means that all things will price themselves to whatever the current interest rate is of the sovereign. If the sovereign's interest rate is lower, you can generally expect that its dollar or its currency will be weaker. And that's exactly what's going on here. The expectations of a Fed rate cut that we've seen literally for actually 2 years finally resulted themselves in a 50-point basis cut. But it was the expectations that drove the dollar lower in price. And so now the dollar is sitting at very kind of, let's see, we're close to we're getting close to the lows of about a year and a half ago. And again, I'm not so sure that the dollar is going to get much weaker here. It's just coming more into line with the interest rates of other countries around the world that did not raise their rates as much as we did. Going forward, if there was any other market that I think is really interesting, I do see a few things that I thought caught my eye recently. It is the cruise lines. Had a tough day today, but as you can see, the cruise lines have been following in this kind of trading pattern that we always see. However, they're right at their highs here, and they're coming off. Here's Carnival, and down below it, I think we have Norwegian Cruise Lines here. Again, it just came off their highs. This is something that we've seen. It's a good market to trade, but we're not traders, we're investors. Nice to have in your portfolio right now, though. I'm keeping an eye on this CrowdStrike here. CrowdStrike is the internet security provider for most of the major companies. It had the huge hack that caused the market to collapse from 387 to literally $200 a share. Obviously, almost a 50% haircut, but it is starting to recover. The question is, where does it recover here? There should be resistance in this area. We'll see. That being said, if the market continues to rally higher, it is kind of first in class in this space, and it looks kind of promising to me. So I would be an owner of CrowdStrike in here. Here's an interesting company I'm just starting to watch. It's called Digital Realty Trust. It's on my radar. I'm not doing anything with it yet, but it's a company that makes data centers. So if you need a data center, somebody's got to build it. Who does that? Well, here's a company that does it. So, and this company obviously has been doing well. Take a look. It's gone from $80 to $160 a share just in the last year and a half or so, a little less. So it's doubled. We don't know where the future is here, but one thing we can be sure of is data is a prominent feature of any future that this country has. And I think that you can say that around the world. So I think that's an interesting company. I'm starting to put it on our radar and to see if we should be able to add something like this to our portfolios for the long run. I think today I've done a quick run through it for the markets, and I'll think the best way to kind of put a compendium on this is to say the interest rate cut, as I mentioned at the very beginning of this podcast, 50 basis points came at a time that I've never seen before, which is when the markets are already at all-time highs. This is very unusual. But for that matter, what has not been unusual since 2020 March, COVID? Everything is unusual. Our politics are unusual. Our prices are unusual. The things we treasure seem to be changing. The one thing that is certain is death and taxes, and that's about all I can ever rest on. But I can tell you this, that the markets will be here tomorrow. They will be here 10 years from now. The question is an interest rate cut at all-time highs just another reason to buy the market here? And as much as I want to be a naysayer and try to bet against that, it is really hard to bet against the fact that when money starts to earn less in a cash sweep account, we're essentially being told to take more risk. And given that backdrop, there should be a higher focus on yield-bearing securities, things that offer dividends, I think will become more treasured. And that's one of the reasons why I pointed out AT&T and Verizon. These are very well-known companies They offer good dividends, 1.5% higher than cash, and they're going up. That's one of the reasons I think these stocks are moving higher, is because the market recognizes that there's a lot of dividends to be had, and it might be a better place to put your money than just in a cash sweep account. So that being said, I think we can go into Q&A and introduce Rob to bring us some new thoughts and ideas.
Yeah, not to put you on the spot, Rob. I was going to say, do you have anything to add to what Kelly was saying?
Well, I think the dividend stock analysis is an important note that I was going to ask about before Kelly kind of summarized with that, which is it's just a really important thing to consider. And I guess the sector choice is important. And Kelly, you could probably speak quite a bit to that. It's been a tricky year for energy, and it's been a tricky year for commodities associated with energy. I know that some of your favorite dividend-bearing picks are Plains and Energy Transfer, and those two symbols have been kind of tried and true components of smartfolios as well. They also pay really healthy dividends. And so when you mentioned the investor being kind of coerced into taking additional risk, whatever asset class that might be, but probably within their larger retirement accounts and their portfolios in general through equities. If there's a particular sector other than you mentioned AT&T or some of the banking stocks that seem to be still performing really well, that someone should consider doubling down on with respect to dividends.
Yes, I can add to that a little bit. The only other things that I think are interesting there is the one I just pointed out, which was the this particular company here. They do pay a dividend, Digital Realty Trust. Anything that is kind of a REIT. These are, when you build a data center, you need real estate to build it on. So generally, the companies that buy that real estate will lease the construction or the lease the property to a company that will put a data center on there, knowing that there's going to be a very long-term lease with a company that has a high probability of being able to maintain payments. So things like that. And here's another one. It was Boston Property, or sorry, I've got to find it. Boston Properties. I got to remember the symbol. It was another company that is a REIT, and I can't seem to find it quickly for some reason. It seems like I can't find them when I need them, and they're always somewhere on my radar. But
it'll
again,
be a great follow-up clip.
Yep. Okay, we'll make that a follow-up clip. The main thing about these things, though, is that where do you get dividends? Generally, you get them from oil companies. The other place you get them are utilities, which we mentioned, and the other place you can get them are REITs. So another example, let's take a little peek at American Tower. And of course, here's another REIT, pays a dividend. Let's take a look at what it is. $1.60 on 235. So $4 to $6.40. You're paying about just about 4% on that, but you have possibility of price appreciation. One of the things is that when you buy property, you want to make sure that and you want to lease it out in terms of a REIT to pay a dividend. It has to have a sustainable long-term customer. And of course, in this case, the customer is American Tower's customer, or guess what? It's the utility companies. The utilities buy and lease the land to put their towers up on. So again, it's a horizontal move from telecoms. So those are the three main spaces. We'll just summarize: energy, telecommunication, and real estate trusts. And so they exist in many forms, and we have them in many of our portfolios.
Amazing.
Awesome. Rob, riffing off of the dividends, that's a question I get asked a lot when people set up demos with me. They're always asking, hey, do your portfolios pay dividends? I know you kind of build content for people that are just kind of finding us, I guess, for lack of a better word. I think you probably have a really good idea as to what you think leads to people having success on our platform. I could name a ton of things, but I know you have your own expertise and also opinion on that. Anything that you'd like to share around, customers and just what leads to success on the iFlip platform?
I think it's an important question because AI Circle is traditionally a a space that a lot of veterans, iFlip veterans, tune into. But we recognize the fact that we have people who came to iFlip with one objective and over time have opened additional accounts, whether it be a retirement focus or something else. And then, of course, we have a lot of new customers. And so it's not always the same journey for everyone. So I kind of like to always get back to basics with respect to how the platform is designed for the mass customer to succeed. And I think, once it's very easy to open an account, and the onboarding process has evolved over the years to really make it incredibly quick. And that experience is obviously very important, whether it's a desktop account or a mobile account that you're opening. But once your account is open, the key to success is locking into a core strategy or a core smartfolio. And there's a really simple reason why. The true power of iFlip and its algorithmic and AI technology is in its long-term ability to be protective in nature. And that protection is what yields actual performance over time. And so I think people often mistake that. They think that an AI product or an algorithmic product is hyper focused on actively trading to yield some more impressive return because it's incredibly quick. And the truth behind it is that protection is a lot more important, and it's what makes us different than a robo-advisor. So when you take that concept, the concept of active risk management within an individual's portfolio, a core strategy is a great way for you to say, look, I'm here and I'm trying to get here. I want to retire at this age. I'm saving for a house. I want a safety net, or I just want a fund, or I'm saving for college. It could be any of those things. And when that's the case, the core strategy, there are 3 of them that we offer, is really something that you want to choose based on your goal and your risk tolerance, conservative, balanced, or aggressive, in short. But there's a lot to discover there when you actually double down into it. But you want to put that on cruise control, and you want to really feed that strategy as consistently over time as you can while you're doing everything else in your trading and investing world. And that really means that once you're invested in a core strategy and you're actively contributing to it through recurring deposits or when it makes sense for you in your life, that you're getting the power of dollar cost averaging and the compounding. And you talked about dividends before. Dividends are really important, right? Because they're included in many of the strategies that we have. And by allowing the products to compound them over time while you're also investing consistently, the longer you stretch that out, the more benefit that you get. That is important with any investing strategy. iFlip is really the only one that's going to add a layer on top of that in your core smartfolios. It's going to pull you out of harm's way. It's going to pull you out of danger when a correction or a crash or something significant is poised to happen in the market. And that's the difference. We're not afraid to put you in cash when it makes sense to use cash as a position. You won't really find that at any other robo-advisor. So the key to success in that respect is consistency over time with the power of AI in a core strategy. Once you have that covered off, and every investor should have that covered off at iFlip, it's really designed for that. Then you can start looking at what we would classify as additive strategies or additive smartfolios. And those are things that we've designed that are sector focused, or they're asset class focused, or they're objective focused. A good example we talked about already was BitFlip. Obviously, that's a crypto focused or a Bitcoin focused product. We'll talk about it a little bit. But then there are things like Red Oil that is energy focused, and there are others that are technology focused, and more that we're going to create in the future. And those additive products are sort of like the level after your core strategy that allow you to inject a little bit more risk into the portfolio, but also greater reward, or allow you to align with some of the interests or values that you have as an investor. And they're also created based on what we get as feedback from a lot of customers too, which I think is important. You've got 2 sort of things that are happening. You've got Kelly and me and others at the company who are looking for opportunity, and they're saying, this is happening in the future. We could really benefit from giving our customers a product that's focused on it. And then you have people who are raising their hand and they're saying, I want exposure to this thing, but I don't really know how to do it. And we're getting those questions enough, or we're getting that feedback enough, that we then go ahead and construct something to leverage our technology in that respect. And so, that's it. It's pretty simple. We're not trying to make it complicated. Your 401k at your employer can be pretty complicated. You have to choose the funds, you have to choose the allocations, you have to choose the target dates, you have to rebalance, you have to look at all of those things. Let's take that out of the equation and make it really simple for you. You want to achieve wealth over this period of time. Consistently contributing to a core strategy will get you there. And it'll probably get you there for less of a contribution than you think.
Yep. Just to add to what you just said, in the onboarding experience, or when you're setting up those recurring deposits, the recommended direction or place that recurring deposit goes is your core strategy. So sometimes I get the question of, what's this core strategy for? Just like Rob said, if you want $100 a month to go into aggressive or into balanced, you don't have to think about it after you set it up. It could be on the 1st of the month, the 17th. You could do weekly for all we care. But as to Rob's points, pick a core strategy. If you like a specific sector, you're welcome to obviously add that too, and just use the power of time to your advantage, I guess I would say. Kelly, you have anything to add to that? I know Rob did a great job there, but
yes, he did. One of the things that, of course, I will take away from what Rob just said is the point that when people think of algorithms or machine learning and any kind of a science applied behind a symbol or behind a portfolio, the first concept that might pop into their mind is more active trading, because that's generally what comes to mind when people are using these kind of tools to be able to maneuver in and out of the market. However, we definitely have a twist on that. We understand that our customers are not traders, they're investors. Investors are not well suited for trading for a variety of reasons that is just too long to go into a list to go into right now. But the most important thing is our science is trying to be able to allow people to maintain their positions as long as possible, and yet still manage the risk. When I started this company along with Randy many years ago, one of the first things a person told me before we ever did anything was, hey, I'd like to be in the market, but I want to have a stop. I want to be able to get out if the market's not good. I'm happy to get back in, but how do I manage the risk of just owning stocks and walking away and say, okay, I'll retire in 30 years and just expect all those stocks to be better in 30 years. That doesn't suit well for anybody that has half of a mind to say, hey, wait a minute, what happens if everything is good and then at some point I'm in my 60s and the market goes down 70%, which we've seen this happen before, especially in technology. And what will you do then? In other words, you're counting on a retirement that's based on a portfolio, but you had no plan to get out. Your plan was always buy and hold. That is not a plan. Yeah. It's definitely not a plan. And that
I would also go back and I would say, to your point about investor versus trader, every trader will tell you that they also invest. It's a different strategy. It's a different mindset, right? There's never been a 15-year period in the existence of the American Stock Exchange that has resulted in a loss if you buy and hold, and in index funds. And so when you're long, right, time is your ally. It's the opposite of the casino. And at the end of the day, if you're trading, that's wonderful. Like, iFlip doesn't want you to not trade, but make sure that as an investor, you have a long strategy and you do it with the type of risk management tools that the wealthy have. And
exactly.
You don't need an advisor or a wealth manager that's used to managing hundreds of $1 millions to do that for you.
No, not unless you want the wealth manager to be doing something exotic. If you're paying him to do something exotic, then you should be paying him quite a bit of money. The problem is most money managers do nothing of the sort. They have a bucket of portfolios. They talk to you. They put you in one of them, and then they hold your hand up and down. They become our rabbis, our priests, our pastors. And when I go to a money manager, I don't want a rabbi. I don't want a priest. I don't want a pastor. I want someone that's going to manage my money, not someone that's going to hold my hand when things are bad. So that is, I think, a fundamental difference about how we do things and how we apply science to longer term investing. I think that's a crucial point, and that is a very important point to point out about the difference between us and, say, for example, beyond the many other differences of a robo-advisor. The robo-advisor is really doing some very, very basic things. They tend to put you in ETFs. They tend to rebalance your portfolio once a year. Harvest losses, all of those things, frankly, if you look at the real data behind it on a smaller account, 50,000, 100,000 or less, mean nothing. Yeah. Tax loss harvesting means nothing. There is no real advantage on those kind of accounts. And so, but they make it sound like it's so important and they're so efficient. But what they're really not doing is managing your risk.
Well, I think that we can talk about that for a minute. Robo-advisors, I just want to be fully transparent. We're a great step in the right direction for most of Americans or the world. And I think the reason why is that psychologically investors and traders, they tend to make the same mistakes over and over again. And we're just not really constructed as humans to make the right choices when it comes to managing our own money. And one of the things that we do is we are not consistent. We tend to be reactive emotionally. And we tend to try to time things that we can't possibly do because emotions are involved. So when you inject a robo-advisor into the equation for somebody who's not going to be able to have the time to actively manage their money, and also has a history of perhaps making the same mistakes like most of us do, you improve the performance if you follow what the robo-advisor suggests. And it allowed for most Americans to have a lower cost of entry into investing, and I think that makes a ton of sense. But it hasn't evolved to where it could with respect to risk management. And I believe, and I might be wrong about this, but I believe that for the robo-advisor products of the world, that downline they will include artificial intelligence. They will include risk management. Even if it's a gimmick, it will be a part of their platforms, because just like you see now, like just like you can use AI to write your emails quite literally built into many platforms, you will also be able to use AI to construct portfolios or to activate strategies for the individual without using a money manager. But I think right now there's no reason why anybody who has $50,000 or $10,000 or $10 million should accept the answer of buy and hold no matter what, indefinitely, no matter what, because there are tools available like iFlip that allow you to do better than that. And all you have to do is really try it for a little bit of time, and you'll realize that some of the advice, while it makes sense over the 25-year period, no one should really be exposed to the bad timing of critical times in the market. I mean, if you had wanted to retire in 2009, that would have been a really big problem. If you had retired or made a really emotional mistake when the COVID crash happened, that would have been a really big problem. I think those are things that we can avoid now, and we should.
Right. I 100% agree. And I think, again, you look back at the history of robo-advisors, they were a product after the 2008 financial crisis. Most of them, that was the time when many times the pundits on television would say, is buy and hold dead? Now, it's completely been forgotten. 15 years later, 16 years later, the thought of is buy and hold dead, it seems to be alive and well up until the next crisis occurs that forces us to re-examine that. And that's just the way of the market. And that's one of the reasons why humans are not stable when they're trading with their own money or investing even with their own money. It's because They don't right now, since they haven't seen a crisis in quite some time, other than the short crisis we had with COVID. They become complacent and they have an expectation that the market will go up. And so when they look at it over their shoulder every day, they, oh, the market was down a little, the market was up a little. Oh, market was really making new highs. So they become very complacent and they forget that things do happen. And when they happen, there is no plan behind that money advisor, including the robo-advisor, to be able to preserve your capital. Their plan is to keep you in it and, again, hold your hand when you're having to go through the muck and mire that sometimes exists in the market. So, again, it is I think iFlip is more of an evolution of a robo-advisor, maybe an order of 2 or 3 magnitude higher, because we do take symbol by symbol risk. And that is something that, again, I'm not really aware of other companies doing that and massaging their portfolio in such a way to construct very similar portfolios, but construct them in such a way that the science actually will allow you to take bigger risk appetite without the risk.
Perfect. We got a couple questions in the chat, and just in case anyone joined later, we're in the Q&A portion now, so feel free to get those questions in the chat. The one I want to start with, I want to get both of your inputs on this. Adrian asked, how much do I need to start investing? So the technical minimum, any smartfolio, basically to get into one smartfolio, you just need $500. We have everything fractionalized. You can, have quarter share of Apple or something like that in a portfolio. I want to get both of your opinions though on, and again, we're not giving advice here, but what would you say, maybe to rephrase the question, is like a recommended amount to say, take advantage of a core strategy and one of the additive smartfolios someone might be interested in? Rob, we'll have you go first.
Well, I think the key is to start investing. And so we never want to create a barrier to entry, but I would say starting with what you can afford is fine, but making sure there's consistency to the contributions is even more important. And I think that's advice that you'll get from anyone. So many of our smartfolios, as Lee said, have a minimum of 500. And that's only because there's just only so much that we can do with the strategy at that, below that point. So I think that's a pretty decent entry point for most people, in America. And we see a lot of people who are contributing $25 a week, $100 a month. And all of that is completely acceptable, because what's going to happen is you're going to see that compound over time. I also think a lot of people employ the strategy of tranching. So in other words, something happens, like they get a bonus at work, or they have unexpected cash flow that comes in, and they use something like the 1/3 rule to take that money and put it to work. 1/3 goes long, 1/3 goes into something that's more necessary in terms of like a home repair, and 1/3 goes into more disposable income. Sorry. And so I think looking at it that way is a really good strategy. And again, your core performance will reflect that over time.
Kelly, anything to add there? I mean, maybe slightly differently, like what, because let's be honest, like Rob was kind of saying it, if we have 0.0002 shares of everything, like we could make 20% and you might make a couple cents. So, and I'm exaggerating here, but just go ahead, Kelly.
The $500 minimum was set up because, yes, I mean, look, in order to invest, the first thing you have to overcome is the inertia of setting up an account. Once the account's set up, even if you invested a smaller amount than $500, 500 is a very good start number. What it does is it keeps you interested. When I look at a stock, for example, and I'm looking at something, what I always do is I buy a small amount of it for myself. Because once you buy something and own it, you pay attention to it. So towards Rob's point, when you own a fraction of a share, now that that's available to people on our platform and others, then technically your $500 can behave like someone else's 50,000 or even almost like a $5 million account, because in terms of value, in terms of shares as a proportion of your total money, it works out to be the same. The thing is though, the inertia to overcome, to be involved. So we set the $500 rule because generally $500 is enough to make sure someone is going to pay attention, to say, okay, I put 500 here. How's that doing? You know, I see people put in 20,000 to say, hey, how's that doing? They don't care about the 20,000, but you know, they expect it to make money and they do keep an eye on it. And then what that does is it leads them into the other products. They say, you know, hey, wait, I put it in balanced portfolio. Let me take a look at the red oil portfolio. What is that? And then they go in and they say, you know what? I'll add another 4,000 to that.
Incidentally, I care about the 20,000, but I would just say, I would encourage everybody who's on this, who probably already has, but I do this with my kids too, and it's an exercise that most people who aren't active investors don't do. Right? Is get yourself go to a website that has a quality investment calculator, and play around with weekly contributions over time, and you'll be shocked. And also be conservative with the interest rate or the rate of return, right? Just to really set your expectations, low, so that you're impressed. And you'll be surprised with what the amount of money that you spend on, I don't know, disposable things that you really don't remember. If you can try to calculate that fictional number in your head, what you spend on subscriptions for streaming services in a month, or what you spend on coffee and beer in a month. And take a look at that number if you were to invest it every Monday, instead of when you remember to do that, and what it does over 10 years, 15 years, 20 years. I think you'll be blown away by that, and it'll give you a perspective on what happens in a really bad market. Or imagine what happens when we have runs like we're having right now over time.
Perfect. Rob, I just got a text. This person joined right when we were at the end of the BitFlip conversation. Not that you need to repeat anything, but anything you want to talk about as it relates to BitFlip that maybe these folks on here don't know yet, or just take a deeper dive into it. I'll let you kind of run with it, but we got a question about BitFlip.
Yeah, I would just say many of our customers over the course of Bitcoin being, being possible for individuals to buy Bitcoin, many of them wanted exposure to crypto and Bitcoin on the iFlip platform. And so we kind of walked away with that, and we thought about what would be an iFlip approach to Bitcoin. And of course, the green lighting of the ETFs in America made a lot of different things possible for us as a company that uses technology to manage investments and uses algorithms and AI to manage investments. We really thought about what is it that would prevent somebody who they're not comfortable with owning physical Bitcoin, right, a la Coinbase or something else. What is stopping them from buying an ETF or from buying another product like a GBTC that is a Bitcoin trust? What's stopping them from doing that? And the answer is really simple. Like, they're afraid of the price volatility that exists, and they're afraid of these massive swings that we see with Bitcoin. They want to participate. And in fact, I think we're going to start to see many of the traditional banks and wealth management firms start to recommend a percentage of portfolios participate in the space over time. We're going to see that more and more as time goes over. So it's going to be something that people want to do. So when we constructed BitFlip, we said, okay, so how do we level out that volatility? So the strategy is that we take 50% of every dollar that's invested in BitFlip, and it is buy and hold Bitcoin long through the iShares BlackRock product. And then 50% of every other dollar is actively managed in and out of the asset over time through our algorithms and through our artificial intelligence. And what that does is that tremendously reduces the risk of you being involved in a price swing that we've seen with Bitcoin, where we lose 12% or worse over time. Certainly, it's going to reduce the downward part of that journey. And it's also going to allow you to buy back in without you having to do anything into that asset class at the most opportune time while it's going up again. And again, it's not actively trading. We're not trying to take, a 0.5% here and a 0.5% there. We're trying to avoid massive swings in price, give our customers less volatility and more security in the asset class, and make it more possible for people to participate in the space over time in a sophisticated yet simple way.
Awesome. Oh man, there's so many questions in here. I was just typing away and trying to get to all of them. Let's just dive into a few. Kelly, this one's for you. This is from Adrian. You may remember last time he was asking all the AI related questions, and he was our winner, I believe. Don't quote me on that, but basically, and I do remember this as well. He talked about, likely a 25 basis point cut. Obviously, it ended up being 50 last Thursday. Basically, the question is, with that being said, do you think the market will slow down because of that?
You might think that 50 basis point cut would have maybe scared investors to think they're thinking that the Federal Reserve feels it's necessary to cut in a larger way to prevent possible recession. However, Powell's comments after the announcement kind of assuaged that, pointing out that almost an admission that they were behind the curve. And that they should have cut interest rates sooner. So no, I would not expect the stock market to kind of fall because, again, already expectations are for further rate cuts. We're not noticing that at the 10-year note, but it is definitely showing up in Fed fund futures. So the direct answer to that is no. The 50 basis point cut is in, and it doesn't, to me, at all suggest maybe a lagging market. What I do see is a market that's trying to consolidate at these higher levels. It's having trouble coming down, and it's having trouble going up. But the longer this lasts, and we maintain the same circumstances, the odds are for a further boost to new highs.
Cool. And piggybacking off that, this question, with more expected rate cuts to come, what do you think of bonds, either corporate bonds or treasuries?
Well, obviously, the clear effect is that if they're AAA rated bonds, or they're going to go lower in yield, and corporations will be able to borrow at a cheaper rate. Prime rate has already come down. Corporate bonds offered by the best companies, those rates are going to come down. Gives them better borrowing power. So again, whatever the Fed does, generally the best corporations are also going to either be hurt or be helped by what other Fed actions are, because all rates, corporate or not, at some level are going to be a direct relationship to the Treasury rate.
Perfect. This was a really good one. And I actually spoke to this gentleman yesterday. This is from Jeff. And we kind of had this conversation, but either one of you can kind of take it first. I do want to get both your opinions, but basically he said and he just opened an account and just funded it. Rob brought up something about dollar cost averaging into the account. Basically, Jeff saying, he perceives this to potentially be a top. Obviously, dollar cost averaging, you don't want to raise your cost basis and keep buying the stocks as they get more and more expensive. So just either of your opinions on that.
My perspective is really simple. The whole purpose of dollar cost averaging is always be buying. And I think that that doesn't mean that you should be trying to time those tranches in. That means you should be consistent about how you spread it out over time, because we never know when the top is and we never know when the bottom is. So if we like a particular index or a long strategy, we should always be taking advantage of the current price. You're going to add a layer of protection to that because iFlip is protecting those investments. So that's a really important thing that doesn't exist when you dollar cost average on your own. Kelly, you want to add to that?
Yeah, I can, because first of all, dollar cost averaging is essentially the same thing you're doing when you're making monthly contributions to your portfolio. When you make those contributions, and Rob is 1,000% correct if 1,000% exists, to say that if you put money in and you have a conservative rate of return, I mean, it won't take much work in a spreadsheet to realize the value of compounding. So the market is not, it is a compounding vehicle. Generally, the market goes up. So it does go higher. And when stocks release a dividend and those dividends are reinvested, or you put more cash in and then the cash goes back into the market and buying either the fractional shares or whole shares or groups of shares, you really are effectively dollar cost averaging by just doing that. That being said, if there's a market top, perhaps there is, but it should still not prevent you from putting in money every month or every week or some kind, however you decide to add to your portfolio. And especially in our platform. Our platform, remember, does move to cash. So if you put your cash in, and by the way, your cash had nowhere to go because we're out of the market. That means when the algorithms, AI say, let's go back in the market, you have more money to do it with. And therefore your prices would be cheaper anyway. Generally, they're cheaper when we get out of the market and then we subsequently get back in. So those things are definitely mutually exclusive. You should always try to add. It makes a huge difference. We don't talk about that enough. But everybody knows what they call the miracle of compounding. And if we understand that, there is really no better mechanism than the U.S., than stock markets.
If you're long,
be able to take advantage of that.
If you're long, right, all you got to do is load a chart of the S&P 500, zoom out to the all as far as you can, and then, ask yourself why you should be worried about tops.
Yeah. And by the way, you're looking at one on the screen.
I'm not sharing your screen.
If you shared my screen,
I gotcha.
that is the forever. So we're going back to the 1930s. It doesn't really, you can't, when you look back here, remember the way this chart renders, and even if I did this logarithmically, the way the chart renders is all these periods of time, all the way from the 1920s over here on the left, all the way up through 1986. This is the beginning of the Reagan administration in here in the 1980s. You see, it looks like a flat line, but believe it or not, it looked a lot like this back in those periods. The difference was it was moving around in percents based on a smaller nominal amount. So you're looking at the classic example of that thing we were all told as kids. What would you rather have, $1 million, or would you rather have a penny a day for a month and double it every month? So 1 cent, 2 cents, 4 cents. You realize you have more money if you just compound it. That's the thing. You cannot forget that message that we all generally learned as children. And that is why Rob pointed out, just look at the S&P. Yep. This is the vehicle that does it.
All good points. Let's try to wrap this up in the next 5 or so. We still have to announce our winner. Kelly, this one's for you, and it might be a simple answer. The only thing I'll add before I ask the question, Adrian, if you have any stocks that you want basically us to map the AI on, just send it into mailbag, and I'll have Kelly take a look at it. But Kelly, anything on the radar right now? I know you brought up a couple stocks early on the show. Didn't know if you're looking at those for the AI or just that you had interest in them.
Anything that we have interest in putting into one of our portfolios, our smart folios, is something that we will map. And we map it both algorithmically for risk management, and then we map it again AI-wise to see if we can find any information that helps us manage owning the stock that we're looking at. So it goes through a 2-step process. Currently, we algorithmically, I think there was a question also from the same person earlier, we algorithmically look at 600 stocks. However, on AI, we only have AI running on the stocks that are in your smart folios, and maybe a few select ones behind the scenes that are not in smart folios yet. So yes, we are always trying to look for something else to add. And obviously the amount of resources, computer resources it takes to map any single stock using machine learning, depending on its granularity, is an intensive thing. It costs money, takes time. We want to make sure you run these things right. So we've mapped about 60 or so stocks with AI, and 600 more than 600 using algorithms.
Perfect. A couple people had interest in this answer as well. So Rick said, I'm 65. What's my best options when I invest the minimum? Obviously, we can't give advice, and it's probably going to be a bit situational between all these different people that want the answer, but it's kind of broad. But someone go ahead.
I'll go on that one. Look, if you're 65, when you look at portfolios, you have to look at a couple of things. One, you know that the three core portfolios are conservative, balanced, and aggressive, and you can imagine what they're made for. If you're younger, you generally go aggressive. If you're older, you start to go balanced, and if you're getting towards retirement, you go conservative. If you're putting $500 in, and that is and I sure hope it's not, a large portion of your portfolio, then you have to go conservative. However, if it represents something completely manageable, 65 years old, you could still be aggressive as long as, and this is not giving advice, this is just me making, opining about what I think any rational person would do, is to say, hey, can I lose $500? Yeah, well, then you might as well try for something aggressive. Nothing is more aggressive than owning cryptocurrencies, for example. On the other hand, if you're younger, there's no reason why you wouldn't be aggressive. You have a longer horizon. So generally it works like that. The
Perfect.
older you are, the more conservative you should be.
Cool. And this is similar, and this will be our last question. Just says, what's best if you're no longer contributing to that Roth IRA? You're just investing in your already existing Roth IRA. It's probably same sort of answer, but if you want to add anything different, you're welcome to, either of you.
Rob?
I think that if you're no longer making contributions, the same kind of rules apply, and I would agree with you, Lee. There's not if it has to do with your age, if it has to do with your financial circumstances, and by the way, age aside, there are many times in everyone's career where, for whatever reason, they have to suspend their retirement contributions because they have lost a job, or they've had a life change, or a medical situation, or another priority in their life. And while that's not optimal, it's life. And so what you try to avoid at all costs is liquidating or pulling from that strategy to fund those other things. Because again, even when you're not contributing, time is your friend. It's your ally when it comes to investing. And the longer that you can allow that, because even when you're not contributing, your retirement accounts at iFlip or somewhere else, Roth or not, are receiving dividends, and those dividends are compounding. And so I would suggest that the same advice applies. What is your risk tolerance? What is your age? Which core strategy is right for you in terms of what you're comfortable with? I'm the type of person that's almost always middle of the road, and at times I'm aggressive. That's just who I am, and that's what the type of way that I invest and how I'm comfortable. I also help my mother with investing quite a bit, and she's super conservative. And I think that is what makes her comfortable, and that's the way that she should live. And so I think the advice is to just let the core Smartfolio do what it's designed to do, whether you're contributing or not.
Right.
Perfect. So now is the time everyone's probably seen this, unless you're one of the folks that are just joining us for the first time, and also welcome. Kelly, I'll give you a second. There were a lot of questions in here tonight, so feel free to go pick your winner if you already know. Perfect. So what's on the line here is a $25 Amazon gift card. Kelly's going to pick who our winner is. The only qualifications is you have to be an iFlip user. You also must be invested in a Smartfolio. How you'll claim your winnings is just by emailing us at mailbag@iflipinvest.com. Either send us your account number or just a screenshot of, say, your home screen that shows which Smartfolios you're in. But without further ado, Kelly, who's our winner?
It's Mr. Bettinger. Mr. Bettinger, even though I don't agree with the questionnaire said dollar cost averaging because the market may be at a top, putting all that aside, the question is still right. Even if this market is at the top, putting money in on a regular basis is dollar cost averaging. Make no mistake, they're one and the same thing. If you're making contributions, it is those contributions get invested in the market. If we're at a market top, what would happen is on our platform, the market, many of our symbols will be getting out of the market. So whatever we're buying would be sold relatively shortly. And on the other hand, what happens if it's not a top? So even though I don't agree with the idea that it's a top, and there's plenty of reasons to be buying the market right now, regardless, the question is still a very valid one, and we should always be making the contributions if we can. If those life circumstances are telling you you can't, that's totally understandable. It happens all the time, as Rob just mentioned, a variety of reasons. But on the other hand even though I don't believe that we can never know where the market is going to go, I kind of believe there is science that tells us, it gives us the probabilities of where the market could go. Right now, the probabilities are kind of on the side for higher, as odd as that may seem. So that's the winner.
Perfect. Well, congratulations, Jeff. Again, I'll just put the email up here, and you obviously know how to reach out to me as well. But just get us that screenshot. We'll get the gift card over to you. Rob, thank you for joining us tonight. Kelly, thank you as always. If you have any final remarks, feel free. But if not, we'll let everyone get on with the rest of their night.
Well, here's my final remarks. Thank you very much, Rob, for joining us today. It was great to have you. Thanks for your input and your insights.
My final remark is really simple. Thanks for having me. And also that a lot of the questions are really good tonight. Investing, it can be really confusing. And unfortunately, the industry that we all kind of live in has made it more complex than it needs to be. So with some of the questions that I saw that we didn't get to answer, for anyone who's thinking about changing their strategy, or anyone who's thinking about moving money, or to how to do it right, or when to dollar call, any of those things, our team is really happy to help and to give advice where they can. So Lee is your first point of contact to reach out if you have new account questions, or if you have existing account questions. He'll put you in touch with the broader team, and we'd love to make it simpler for you.
Yep. I was going to say a little bit of that I'm sure we missed some questions, so sorry, but I'll go through the chat here and we'll get them answered next time. Speaking of next time, our next AI Circle is going to be on the 9th of October, same time as always. The second one, we might have to be a little agile with. We're on the road a bit, but we will communicate that to you guys. Thanks, Kelly. Thanks, Rob. Everyone have a great rest of your night.